As a culture consultant, are you making these financial missteps that's holding the growth of your business back? Today, I'm going to talk to you about the 7 mistakes that most business owners make in their financial record keeping, which is causing them to not see the financial growth that they're looking for, or the cash flow, or to have the data that they need in order to make decisions about their business. Hi, I'm Michelle. I am the CEO and founder here at Mitchell Consulting. And today we are going to talk about the 7 missteps that most coaches and consultants are making in their business that is holding their finances back. So let's get right into it. Number one, maintaining, not maintaining accurate records. So this means all of your business records, you can't put your finger on them. They're scattered all over your office in different places. Accurate records means more than your financial records. They are like your business licenses, your incorporation papers, your bank statements, your credit card statements, any loan documents. These are all records of the business. And if you don't have them in one place, it's not easy for you to gather that information and give it to the entities that are asking for that information. So, my suggestion for you to avoid this mistake is to create a digital and a physical record book of your business records. So, maintaining your financial records, number one. Number two, most business owners, coaches, and consultants don't pay attention to their cash. Cash is king. If you don't have any cash in your business cannot stay afloat. And one of the mistakes I see a lot of business owners making is that they are looking at what's in their bank balance, then they make a purchase instead of planning out what you're going to do with your cash. So that is actually one of the biggest mistakes that most coaches, consultants, and business owners make in their business. But the number one mistake that they make in their business is number three, not separating their business and personal expenses. When you have your business and personal expenses commingled in your business accounts or your personal accounts, you are actually piercing the veil of your legal entity, and you're opening yourself up to scrutiny by third parties, such as getting a bank loan. Now they have to go through your personal bank account and your business bank account, or you've been audited and now the auditors have to look at your personal or your business bank account. So it is very important that you separate your business and your personal expenses. The other reason why is because if you're doing any type of analysis on your business and you have personal expenses commingled in, we can't make a real decision about the business because we're actually commingling our funds. And number four mistake is you are not paying attention to your spending in your business. So you don't have a plan for it and you have shiny object syndrome, uh, because most business owners do. And you're not telling your money what you want it to actually do for you. So monitoring your spending and planning out what you're spending your money on is another mistake that I see often with small business owners. Then managing your debt. If you have leveraged debt in any kind of way, which is a smart move, but have you also thought about how you're going to pay this debt off? Because if we're going into debt in the business, it should be to increase our revenue in the business, not or get equipment for our business that will eventually create more revenue in the business. And if we're not paying attention to our debt management, that's another mistake that most small businesses make. Number 5, verifying your records. So, most small businesses, if you're working with an accountant, you should be automatically doing this. But if you're doing it on your own, reconciling all of your financial transactions with a third party helps keep your financial system accurate and helps keep the reporting within your financial system accurate so that you can make better business decisions about what's going on in your business. So just reconciling those asset accounts and those liability accounts every single month is another mistake that I see most small business owners not doing. And you can rectify that quite easily just by reconciling. Number 6. Number 6 is you don't create a budget for yourself. So if you've been in business for any amount of time, you should have enough data within the business to help you create a budget. And a budget just tells you, it looks back at what has already happened in the business, and you're coming up with what might happen for like a 12-month period of time in the business. So you're making a educated guess about where you're going to be increasing your revenue and and paying out expenses in your business, and you just have a roadmap for you to work on. And it's also the basis for mistake number 7, which is projecting your cash flow. So when you have a budget in your business and you're telling your money what to do for you in the future, now it's a basis for actually projecting cash flow in the business. So we take like a 90-day period of time and we're thinking about the activities in our business, like the revenue generating activities, your activities as the business owner, how you're getting visible in the business, and the percentage of people you can attract in the business so we can highly predict how much revenue you're going to generate in a certain period of time. And then we're going to look at, okay, how much is that going to cost us? How much is that going to cost us in our business in order to generate an X number amount of cash? So that's what a cash flow projection can do for a coaching or consulting business or a small business in general. And these are things that I don't see happening in small businesses often enough. So I just went over my 7 tips for mistakes that are happening with your accounting in your business. So just to recap real quick: 1, maintaining accurate records. 2, understanding cash is king and it is your job to protect your cash. Number 3, separating your business and personal expenses. Number 4, monitoring your spending and your debt management. And number 5, verifying your financial records with a third party, such as a bank or credit card statement. Number 6, creating that budget for your business. And number 7, protecting your business with forecasting your cash. And if you need help with any of these, I will put a link there so that I can give you a spreadsheet that will help you monitor your cash, create a budget, and do some of these things that I have just listed above.